Hi friends, good day. Today let us try to understand about what is PE ratio, what are the types of PE ratio, what is absolute and relative PE ratio. According to Jamin Shah, you never know what kind of setup market will present to you. Your objective should be to find opportunity where risk-reward ratio is best.
Please subscribe for more videos. Click the bell icon for updates.
What is price to earnings ratio or PE ratio? Price to earnings ratio or PE ratio is the ratio of company's current share price to its earnings per share. It is used by the investors and analysts to determine the relative value of the company's shares by comparing the company's PE ratio. It also can be used to compare a company against its own historical record or to compare aggregate markets against one another over time. Analysts and investors consider earnings from different periods for calculating this ratio. But the most commonly used variable is the earnings of the company from the past 12 months or a year. It is also referred to as price multiple of earnings multiple. PE is equal to current market price of a share divided by earnings per share, or PE is equal to market capitalization divided by total net earnings. Justified PE is equal to dividend payout ratio divided by R minus G, where R is equal to required rate of return, G is equal to sustainable growth rate. A high PE ratio may suggest two things. One is that the company is overvalued or is on the way to the growth. Another is that the company is expected to have an increased revenue in the future, and the speculation of the same by the investors and the analysts has led to a surge in its current stock prices. However, it can also be interpreted as an overpriced stock in some cases. Companies with high PE ratio are often considered to be growth stocks. The downside to this is that the growth stocks are often higher in volatility, and this puts a lot of pressure on the companies to justify their higher valuation. For this reason, investing in growth stocks is more likely considered as a risky investment. A low PE ratio suggests that the stock is undervalued due to any systematic or unsystematic risk of the market. It can also be interpreted that the company shall perform poorly in the future, due to which the stock prices are falling in the present. Companies with low price-earnings ratio are also considered to be value stocks. It may be because their stock price trade lower relative to its fundamentals. This mispricing is seen as an opportunity by the investor, and it prompts the investor to buy the stock before the market corrects it, and when it does, investors make a profit as a result of the higher stock price. The above may not hold true in all the situations, as the PE ratio varies from industry to industry. There are certain sectors like diamond, fertilizers, or sectors that are very cyclical and they command or have a low PE ratio. Whereas there are certain other sectors like pharma, FMCG, IT have a higher PE ratio. So the PE ratio of a company should either be compared with the other companies in the same industry and of similar size, or with its own historical PE to evaluate whether the stock is undervalued or overvalued. The individual PE of the company without comparison cannot give you much information. What are the types of PE ratio? 1. Trailing PE ratio. 2. Forward PE ratio. Let's look into them one by one. Trailing PE ratio. This is done when the past earnings of a company over a period is considered to calculate the PE ratio. This is the most commonly used metric by the investors. It provides a more accurate and objective view of the company's performance assuming company reported earnings accurately. Some investors prefer this PE ratio as they don't trust another individual's earnings estimates. This also has its shortcomings. Namely, a company's past performance doesn't signal future behavior. The fact that the EPS number remains constant while the stock price fluctuates is also a problem. If a company's event drives the stock price up or down, the trailing PE will be less reflective of those changes. Now, forward PE ratio. Forward PE ratio is calculated by using the estimated earnings of the company derived from its future earnings guidance. As the ratio is based on the future earnings of the company, it is called future PE ratio, sometimes called as estimated price to earnings. This forward-looking indicator is used for comparing current earnings to future earnings and help provide a clearer picture of what earnings will look like without changes and other accounting adjustments. The problem with this PE ratio is that the companies could underestimate earnings in order to beat the estimated PE when the next quarter earnings are announced. Whereas some companies may overstate the estimate and later adjust it by going into their next earnings announcement. Furthermore, the estimates provided by the external analyst may diverge from the company estimates, which may create a lot of confusion. Absolute and relative PE ratio. Absolute PE ratio is the price of the stock divided by the company's earnings per share. This measure indicates how much investors are willing to pay per rupee of earnings. The relative PE ratio is a measure that compares the current PE ratio to the past PE ratios of the company or to the current PE ratio of a benchmark.
Well, thank you so much for watching. Please like this video and do share.